results despite the challenging macroeconomic backdrops in the jurisdictions where the group operates. FirstRand has reported a strong operational performance. The group said its portfolio had performed better than initially anticipated. Group CEO Mary Vilakazi joins us now for greater insight on the performance. Thank you so much for your time, Mary. Let's actually start off there with FirstRand's earnings outperformance that even went ahead of your own initial expectations. What was the difference?
So there were two things that I guess were better than when we were presenting our year-end results in September. So during that time, particularly in F&B, the retail credit experience was really quite severe. So we saw that playing out from January to June 24 in the second half of our financial year.
Yes.
We knew, because we had lent to low to medium risk customers, that as soon as there's relief in terms of inflation coming down, interest rates coming down, they'll start going back to paying again.
Yes.
But we didn't know when the turning point was. So I guess when we guided, we didn't know that the Fed was going to cut rates, then allowing the SARB to cut rates with inflation following. So I think that's the backdrop of the high impairment levels. If I look at the 6-month performance compared to last year for F&B retail, I think it's just marginally up. But I think that a lot of the impairments in F&B last year were in the second half of the year. So, so that's a better print. The other thing as well that I think is also better than the outcome is better than what I expected is our cost management, again, largely driven by F&B. So our cost to income ratio of 48.9%. I mean, FirstRand, we've been trying to get below the 50s for a while. So we will hopefully work hard to make sure that we stay in the 40s range, but I think a very pleasing outcome of our ability to manage costs and flex costs when top line is under pressure. And then I think the other thing as well to then also consider is that in 2023, in the comparative period, we had 2 one-offs from our business, from our investing businesses in private equity and principal investments of about 700 million. So that's about 2% additional earnings growth. So so I guess that's so we had a high base to fill, and so therefore being able to grow 10% from that perspective, I guess that is what we considered better than we had expected.
It's quite interesting. I'm actually thinking about it now with this lower interest rate cycle that we are seeing. It seems that coming through to the consumer side, that has a kind of lag effect where consumers are not really feeling it right now. It's not an immediate impact. What is it looking like on the bank side, particularly when you look at your interest income?
So I think you're absolutely right that consumers are not yet feeling the full impact. And I think that's because interest rates were actually very high.
Yeah.
And so, we're quite cautious that, even we've had 3 rate cuts now of 75.
Yes.
We think that there'll be another one in the next 6 months. And then there could be another one by the end of the year. But that's going to depend on the global inflation and what happens around the globe. But even that, it still leaves our repo rate at over 7%. I mean, that's high if you think about where rates were pre-COVID.
Yeah.
So, I think for the consumer, obviously, we've all adjusted to live now in a high inflation and high rate environment. But I think we're still quite cautious on the outlook of retail because rates are high. But what we have seen, and I guess if I go to F&B, is that we're no longer seeing that high inflow of customers that can't pay. So that the bad debts are starting to come down. So that's one indicator that so at least a bit more people can afford to make the repayments.
Yes.
Obviously, the withdrawal of people's pension funds through the 2-pot system. Some of them have used it to make sure that they catch up with the debt repayments. And I guess the good thing that we've seen, which we're really concerned about, was people that were going for debt review, that went to debt counselors. Whilst they could actually just restructure some of their facilities with the bank, we've seen a reduction in that. So I won't say it's a reduction because people are no longer distressed, but I think it's also got to do with the fact that we became proactive as a bank to try and make sure customers are not having the wrong solve through a debt review instead of just debt restructuring. So so I think we are going to feel better. I think with time to come, with inflation coming down, let's see what the budget holds.
Yes.
And I think also what we really need, and I think what households will need to feel better about their own income prospects is to see the economy growing.
Yeah, indeed.
Okay, at less than 1%, that's not an economy that creates jobs. So we really need to make sure that we're getting behind execution on the identified structural economic reforms and unlocking growth, because I think ultimately we need to get back to growth being above the 3% level, because that's, I think, really when you start getting positive sentiments. Now, having said that, I think what is encouraging that we see is that there is, that business confidence, although still quite low, because, different businesses are experiencing different challenges. But there are certainly some sectors that are seeing a benefit from the economic activity in the business. So, are lending in the commercial space, are lending by RMB. There are opportunities that, I think if we carry on the trajectory of making it easier for business, of providing, I think a stability in our policies, deal with the logistics problem. I know Transnet is trying hard, but okay, we need to move faster there to I think to unlock the exports and support the economy in many ways. So that there are signs. There are things that South Africa can do to improve its own growth trajectory. I think we're not only dependent on things going right or well around the globe to support our global growth. So it really has to be an area of focus and priority, because ultimately that's really where the country's growth is going to come from, and for us as well as a bank.
Mary, very interesting points that you make there, particularly with business confidence. Good to see financiers also supporting businesses as they try to support the economy. Of course, we'll get more information on how the government plans to support business through the budget, and also the B20 and the G20 that are coming. Very impressed with South Africans. Also seeing that a lot of companies are saying that people that had withdrawn from their two-pot retirement have actually paid off some debt. Let's get to the UK quickly before we wrap up the conversation, because as we're talking about a struggling economy there, the UK economy is also in a state of stagnation. I saw that in your results commentary. You also mentioned lower margins. What did the performance picture look like there?
So the business what we have in the UK is a lending business. So they lend, they do property finance lending, business finance, as well as the motor business. Okay, so I'm quite pleased with actually the trading results of that business. So the production was high, so that's actually just loans originated over this period, and they grew the balance sheet, and they have started to focus on margins, which is really what FirstRand, as FirstRand's big anchor point is. I think we don't want to only just capture market share, but I think we have to make sure that we get in the right appropriate risk return adjusted margins from the business we do. So I'm pleased that that's also what they are doing. If you look at the motor business, for a while, it had operational challenges in the business. They've addressed that, and they're back in the market. And we've also invested in the technology, in the platform, and the ability to respond quicker to brokers, because a lot of that business is brokered, and change prices based on what's happening in the market. So property finance origination is up for 72% actually from last year, given that it was a low base. So at least from the day-to-day activities that give you an indication that there'll be a strong advances group, they're doing well. They don't have a deposit franchise than we have here in FNB, so they need to work hard to get deposits, and they pay to get those deposits. So that's what overall brings their margin down. They get it on the lending side, but because they need to pay up for deposits, I think that obviously always impacts their margin. But for me, it's actually more important that they always run with some surplus, because you never know when a market dislocation takes place. And we don't want to send rand to the UK to help them out. They need to run with a surplus to ensure that they've got funding resilience. So that's another place where it's lower margin, but we we're more comfortable to take that position than otherwise.
All right. Well, we do have to wrap up the conversation there, Mary. Thank you so much for your time and giving us more insight on the numbers that came out from FirstRand. That was Mary Vilakazi, CEO for FirstRand.